Ladies and gentlemen, welcome back to the channel. Tesla stock did not have a good day today. Okay, well, it wasn't a terrible day, but it wasn't a good day. Now, I actually think things are looking up for Tesla stock, and I think this market is about to flip-flop. Yes, I think a flip-flop is coming for this market soon. I'll tell you why in today's episode and why it could really benefit Tesla. Now, besides that, BNP Paribas, a bank mostly based in South America, downgraded Tesla today, saying the stock could fall 29%. In fact, that could be a really good contrarian indicator, as Paribas doesn't have a great track record when it comes to Tesla. Now, I am going to share a clip with you from CNBC as well. We will take a look at earnings for tomorrow, as well as any economic data we're going to get. So, ladies and gentlemen, before we get into it, hit the like button as well as subscribe to the channel. Check that link out down below in the description of this video. If you guys want to take this thing to the next level, come invest with us, come join the trading community, get involved over there. What we do, long story short, I know you've heard the spiel before, is we go out in main themes for the next 10 years. We're talking AI, software, robotics, gene editing, emerging biopharma technologies, quantum, okay? Main themes for the next 10 years. We're looking for the smaller cap companies that are overlooked by Wall Street, that have value, that are hidden gems, if you will. And we're looking out for those opportunities. When we find them, we execute on them. And that has been an incredible strategy so far this year. Portfolio, even after today's volatility, is up over 170% year to date. So, the proof is there. But link down below if you guys would like to come join us. I don't take sponsorships, so I sponsor myself in these videos. With that said, let's get started. Okay, so first things first. BNP Paribas downgrades Tesla, sees a 29% drop. BNP Paribas gave Tesla an underperform rating with a $307 price target, 29% downside. The bank says Tesla's AI ventures, Robotaxi, and Optimus currently generate no revenue, but inflate its valuation. Even with ambitious forecasts, Tesla's risk-reward is unfavorable, and 2026 cash flow is projected $4 billion below consensus due to margin and AI software pressures. AI software pressures? Last I checked, that should be a very profitable segment for Tesla. There's a lot, basically all of this, that I could push back on. Here's the deal. If you're buying Tesla, you're expecting AI is going to grow. Okay, if, as we think will happen, you have 20 to 30 cities next year in operation. Now, let's do some, simple freaking math here, okay? 20, 30 cities, let's take a median of 25 cities in operation next year. Let's say there's 100 robotaxis in each city, which is quite damn conservative. That's 2,500 robotaxis in operation times maybe $100,000 a year per vehicle. That's $250 million times maybe an 80% margin on that. Boom, that's $200 million to the bottom line. That's not that impressive. That's less than 10 cents of EPS on 3.3 billion shares outstanding. Okay? But what if you start to use numbers like 25 cities with 500 vehicles in each city? Is 12,500 vehicles in operation times $100,000 in revenue per year. That's 1.25 billion times an 80% profit margin. That's 1 billion in profits. That adds 30 cents to EPS. Great. Forget even all that. Maybe there's 50 cities in operation by 2027 times, maybe, let's say, let's just still go with 500 vehicles per city in operation. That's 25,000 robotaxis. Great. Okay. times $100,000 is $2.5 billion. Times 0.80 is, boom, $2 billion. Now you're adding over $1 of EPS. And that's only with 50 cities. That's not even something that you'd consider like going global, right? That's, it's not a lot of coverage of the U.S., if you will. Okay, what is there? 4,000 counties in America? Something like that. You're less than a fraction of even the counties, let alone cities. So the growth, the runway for growth, and the explosion of profits are insane. Now, rough numbers on Optimus here. Okay, maybe next year Tesla sells 1,000 Optimus bots for $50,000 a piece, $50 million in revenue. Awesome. Okay, times maybe 30%, 15 million in profits. That's not crazy, right? But what if by 2027 or 2028 they're selling 1 million robots, for 50,000? That's $50 million. Okay, or what? Is that 50 million? That's 50 billion. That's 50 billion. Okay, now we're talking some numbers here. Times 30%, assume Optimus is going to have like a 30% margin. That's $15 billion in profits, divided by 3.3 billion shares outstanding. Boom, now you're adding $4.54 to EPS. Okay, the growth that you're going to see is what's impressive with Tesla. Not necessarily next year, but for 2027. Now, Victor here provides some very great insight. He shares Grok's summary of BNP Paribas' track record. Grok says Paribas has rarely ever been right on Tesla forecast, consistently issuing underperform ratings with targets well below actual prices. Example, $137 in April of 2025 versus today's $430 range, missing repeated surges. Their bearish stance persisted through mid-2025, adjustments between $142 and $150, underestimating growth in EVs, autonomy, and energy. On tech stocks broadly, no top-tier accuracy rankings emerge. Their analysts often lean conservative, but Tesla-specific misses highlight overcaution and innovation-driven rallies. Track records favor bold bets over consensus caution. So yeah. Long story short, they're basically never accurate on Tesla, and it's a pretty good contrarian indicator, to say the least. Okay, now Tesla, from a technical perspective, actually is starting to look pretty good. Okay, even after today's not, favorable day. Okay, you're starting to see a series of higher highs, right, and even higher lows, right? Going from October 10th, where the stock hit a low of $411.45. The stock in the last 3 trading days, minus today, has managed to claw back to $431 per share, hitting a high of the day today at $439.35 per share. It looks like you could be gearing up for another move higher. Now, unfortunately, what this really comes down to, because we have the catalyst in store for Tesla. We have the shareholder meeting, Elon's comp package, an investment into XAI. We're going to get, clarity on maybe new models coming to market, Optimus progress, Robotaxi progress. I think we're going to have at least one more city where Robotaxi begins operations this year, right? We're going to have the catalyst for upside. Unfortunately, Tesla stock is not falling, or has not been falling, because of Tesla-specific issues. Tesla has been falling because of trade worries with China, okay? I think that is probably coming to an end here soon. Why do I say that? Well, China said today they're ready, they want to talk. They want a trade deal. Trump does not want a bear market. Trump does not want a recession. Trump wants to look and project power to the world, and I think he does, right? But he doesn't want a recession. He doesn't want a bear market. He wants the U.S. to thrive in AI. I think that's something we could probably all agree on. Okay. The last thing you want, if those are your goals, help the economy, consumer get better, people, get back on their feet, is to have a recession or to have a bear market. So via Trump's China's comments today, the markets, didn't take it nearly as positive as I think they should have. Okay, Russell sold off over 1%. It was a very risk-off day. I think Wall Street should have actually taken this as good news today. Now, the AI Investor Sentiment Survey. Bears have surged. Bears are completely in control of this market. 46.1% of investors are currently bearish, 20.3% are neutral, and bullish investors at 33.7%. Okay, when you start to get bears that are dominating the markets, it's only a matter of time before a reversal comes. Even look at the CNN Fear and Greed Index today. It's at 26. It's 1 point away, lower that is, from hitting extreme fear. Yeah. Hello. This is, again, another contrarian indicator. When things start to look bad, this bad, it's typically a sign you want to be long this market. Okay? And I honestly think we could expect good news at any point when it comes to Trump and China and, trade talks. So you have Trump that doesn't want a recession, doesn't want a bear market. China that can't afford one. Okay, China's already not doing great. You have China willing to talk or wants to talk to settle this. Okay, you have a market that's fearful. Okay, by any metric that you can really point out, the markets are fearful. Adding those together, I think we could see a flip-flop soon. I think we could see markets get better from here. And we are kind of in a seasonal strength environment. Now, October is one of the better months of the year, but it's not a uniformly good year like November is. November is more of a bullish month, right, than October is. December is a pretty good month as well. So I think we still have all of this seasonal strength that could come into play in markets here. Now, the government is shut down. We're not getting economic data. That's obviously an issue, and that might start to weigh on markets at some point as well, that we just need to be vigilant of. We've heard from a lot of Fed speakers, and they're taking essentially the same crap that they said a month or two ago and just regurgitating it again, okay? 2 rate cuts this year, then we'll see what happens next year. Inflation doesn't seem to be an issue. The labor markets are weak, but they don't know if they're weakening further or what's going to happen there. It's basically the same shit we heard a month or two ago, regurgitated again today, which is good, right? You don't want the Fed to come out and say, oh crap, guys, we're kind of in a recession, right? That would not be good. Okay. But yeah, the government being shut down could start to impact markets a little bit more. Just, I don't think we are quite there yet. Now, for tomorrow, we get a speech from Fed Musa Liam at 12:15 p.m., so around noon, lunchtime. You get the net long-term TIC flows, foreign bond investment, overall net capital flows. None of this is really going to be important. We're not getting export prices month over month, year over year, export prices month over month, year over year, or building permits or housing starts. So because the government is shut down, we're still not going to be getting some relatively important economic data. Now, today we did have TSMC earnings, which came in much better than expected. You did have some banks as well in pre-market today. In after hours today, you have Interactive Brokers, CSX, First National Bank, and some other banks. And then tomorrow morning, you have Ally, SLB. Boy, I'm tired. State Street, American Express, Fifth Third Bank, the region's Truist, Huntington, Comerica. American Express could be a little bit more important this time around because the government is shut down. How are consumers doing? Are they still spending? Are they slowing down? Some of those questions, that Wall Street have may be answered soon. And honestly, I could see some, positive developments from a broader market perspective if American Express does tell us good things. Now, despite all of that, another reason I think the markets are about to flip-flop and get bullish again is because of just how well markets have held up despite the trade tensions, okay? This is not our first rodeo. This is actually our third rodeo. The first rodeo, trade war between the U.S. and China, took place back in 2018, and markets fell 20%. When that happened, right here, bottomed on, I think it was Christmas Eve. Yeah, December 24th, markets bottomed. The day after Christmas, the markets were up 5%. What a Christmas present, okay? That was the first rodeo. The second rodeo was back in April. And that was really like a trade war on the world, not just China. China was a big part of that. And a big reason why stocks sold off. Things just got worse with China after that progressively. So that was not great. But now this is rodeo number 3. Now, difference, again, this is not a trade war with the world. This is a trade war with China. So that's good. There's some differences here. But, long story short, it's not as bad as back in April. But you really haven't come down all that much. Now, alternatively, it's not fair to say that because, even though the S&P is only down less than 2% from all-time highs, internally in our markets, some of our favorite stocks in the trading community, some of your favorite stocks have sold off dramatically, right? They're down like 30% from some of their levels they were just at 2 weeks ago, right? Why? Because Wall Street knows exactly what I've been telling you to be true, that this could cause a recession. This could cause weakening in the economy. This could be bad, having a trade embargo with China. But it may not, right? So what do institutions do? Well, when in doubt, you sell the stocks you don't want to hold if a recession comes about. You sell the stocks that are going to go down the most if stocks fall. So simply, like most firms, a lot of firms, they don't even have a say in this. A lot of firms are literally pre-programmed or have clauses where if volatility goes up, if risk goes up, they have to sell the riskiest stocks in their portfolio. Now, that's partially why Wall Street underperforms, but it's a risk management thing. Okay, if we were to have an '08 crisis, you wouldn't want to hold a bunch of junk, right? But alternatively, if you are, doing like what we're doing, taking these high risk, high reward, quality companies under your wing in your portfolio, if you will, those are not the companies you want to sell, when things get bad. Those are the companies you want to buy for the upside that prevails from coming out of this situation, right? So you can't blame Wall Street for selling, the high flyers, the emerging technologies when they are categorized as the riskiest kind of stocks. People are not really jumping to sell Apple or Microsoft or Tesla or Nvidia or some of these well-known established companies. But they're not paying a second thought to selling the other ones, right? The internals of our markets. And that's why you're only down 2% from highs, but the CNN Fear and Greed Index is nearly in extreme fear. That's what it's about, right? That's why. Because internally, markets don't look great. Okay? Internally, there's been quite a bit of pain. Kind of like 2022. 2022 is a great example of this. Yes, indexes fell 20+% at the drawdown. But, under the surface, a lot of stocks were down 60 to 90%. A lot of those were quality companies and ended up coming back, right? Some of them were not. Some of them have never come back. Okay. But it's just what happens when you have a higher risk environment. Wall Street, either knowingly or willingly, or maybe it's programmed, right? Into the fund, when volatility goes up, they sell, the high flyers, the new emerging technologies, the less established companies, the small caps, if you will. It's not their fault. That's just how they have to operate. But if you are advantageous and you do not fear a little bit of downside and you have a longer term perspective, I think a lot of stocks right now do and are starting to look very attractive. Okay. That is why we are starting to do more and more buying as those areas are selling off. But yeah, I see a flip-flop. I see a reversal coming. It's just really a matter of time. It could happen today. It could happen into tomorrow. Could happen in this upcoming week. But I do think within days, you're going to see Trump try to cancel this trade war with China, come to some kind of agreement. The art of the deal, right? Create chaos, create uncertainty, get a little bit of leveraging power. So, yeah, I think that's coming soon. Let me know your thoughts on this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. Again, check out that link down below in the description of this video to come join the trading community. With that said, have a great rest of your day, and I will see you in the next one.